and what's been happening in the oil drilling here in the United States. You're an oil services company, and I think you have equipment on about 10% of the wells that have been drilled in the United States this year.
Yeah, that's about right.
Let's talk a little bit about what we see both from the supply and then the demand side first. In terms of where oil prices have been before this incident today, oil prices were down 4% yesterday on concerns, I think, about supply here in the United States. What do you see?
Yeah, well, I think there's a lot of pressure just with the general trade war and economic growth and where that's going, and I think that's been weighing. I also think you've had surging U.S. production in the last 6 to 18 months, and that's been putting a lot of downward pressure on prices. People are really also worried about the supply build that's been, the inventory build that's been happening recently.
The first thing you mentioned was a demand picture. You think that's a bigger part of the deal right now, that people are concerned about a potential recession?
It is. I think it's potentially I think it's potentially oversold. Or a little bit too much downward pressure on the price of oil based on demand, because I think that if the economy slows, we're talking about a slowing of growth, not a contraction. And I think that the oil consumption is going to be higher.
What have you seen just in terms of how much demand there is to put on new oil wells this year with crude oil prices just above $50?
Yeah, so there's actually a lot of demand, and I think really the story is about oil going up and down, but the story is also about the U.S. and U.S. shale, particularly the Permian, continuing to take market share from OPEC. And so I think there's two different stories. There's an X and Y axis going on. And so the U.S., OPEC is in retreat. OPEC production is down about 2.6 million barrels from last year at this time. And that's really been taken up by mostly by U.S. production. And I think that you're going to continue to see, as these pipelines come on in the Permian, in the second half of 2019, I think you're going to see transportation costs in the Permian fall. And everything else being equal, the U.S., particularly the Permian, continue to take market share from OPEC.
So what do you think when you hear stories about these tankers being attacked in the Gulf of Oman today?
Well, it's pretty alarming, and I think it's got to be very, very stressful for people involved in that segment of the world. But the Strait of Hormuz has about 18 million barrels a day of oil pass through. It's about a little less than 20% of worldwide demand, and so it's really a choke point and really could destabilize the world. We forget how 20 years ago supply disruptions in oil and gas were much more prominent, and we've really, I think, had a sea of calm until these attacks. These 4 ships attacked in the UAE last month, but maybe we're entering a new era, and maybe the global supply needs to not be taken for granted as much, and we need more slack in the system.
All of Saudi Arabia's oil has to come through the Straits of Hormuz.
Yeah.
So
yes. And of many other Gulf producers.
Of Gulf producers that are there. With tensions like this, what does that do to your industry when you're talking about Permian Basin drilling? Sure.
So I think it shows that the Permian Basin is a much more stable market, and it's onshore. So there's really, transportation-wise, it's a lot less complex, and there's a lot less room for supply disruptions. But I also think it has a foreign policy component, because as we produce more and more oil here, in the U.S., in the Permian, there's more room for U.S. security envelope to be different from what's needed in the rest of the world. And so I think it gives the U.S. a little bit more of an ability to push, be assertive with Iran or be assertive with people in the Gulf for foreign policy reasons, because we're not going to have an oil supply strike like we had in the 70s with the Arab oil embargo.
We watch it from afar, where we hear Chevron talking more and buying up more space in the Permian. You hear it from ExxonMobil being interested in the same sort of assets. And then this big deal for Anadarko, Occidental raising its price and going after that. How does that play out on the ground there?
Yeah, so what it means is it's becoming, we saw this in the Bakken 5 to 8 years ago. It becomes more and more of a bigger players game. The service companies need more scale. And there's less mom and pop operators. There's a race to scale, and I think you're also seeing the internationals and the majors come home. So why be in Mozambique? Why be in Indonesia when the Permian's a world-class oil field, and they can get the scale that they need there and much safer? As today's events show, the world's a risky place. The world's unsafe. Why not be in the Permian Basin where you can have scale and it's safer and deploy capital there?
Where are we in that evolution, if you say this is kind of following the arc that we saw in the Bakken 8 years ago?
Sure. Well, I mean, I think, what is it they say? History rhymes but doesn't repeat itself. I think that you're going to see more consolidation. I think players like Pioneer, Exxon, Concho potentially could merge or be bought. And I think that the Chevron Anadarko, the Chevron Occidental fight over Anadarko may just be the first inning of, further consolidation.
We see the monthly jobs numbers. Obviously, it's full employment. It's difficult at times to find employees. We hear that from a lot of industries. What do you find in your industry?
Oh, it's extremely hard to find people. It's extremely hard to find good people, and I think we're blessed at Canary with the team we have. But it's very, very difficult to recruit people. The safety and the compliance regulations continue to get tougher, and it's a challenge to hire people. And I think it's a testament to the good economy, but it's something that worries us as we move forward. How do we hire and retain great people?
What's your best guess about where oil prices are headed when you have the pressures of concerns about the economy, but also looking at potentials for tighter supply?
Well, first I would watch what happens with the OPEC meeting that's about to come up. I think that OPEC plus Russia is a floor on the oil price, but they that's what them anticipated to extend the cuts. If they don't extend the cuts, then all bets are off and the floor goes away. I think they will, or they'll surprise with a little bit even bigger cut. But again, I think it goes back to what I said a couple minutes ago. This is about OPEC. This is a long, slow retreat of OPEC ceding market share to U.S. shale. So it's about oil going up and down, but if you're a U.S. investor or investing in the U.S. oil field, it's also about taking market share. So at the same oil price, you're going to do better. And then I think in the Permian Basin, you've got the pipeline capacity, the takeaway capacity, set to double in the second half of 2019, first quarter 2020.
Sure.
And that's going to lower the transportation costs, the discount to WTI, that's been kind of in the 8 to 12 range for a lot of companies. You're going to see that fall to the $3 to $5 range. And so even at the same oil price, the Permian is going to get additionally more competitive as we enter the back half of the year.